14% of Americans now own Bitcoin or cryptocurrencies. Bank of America has released a new 140-page report covering digital asset industry, including NFTs, institutional investments, and the rates of growth. It's called the Global Cryptocurrencies and Digital Assets Report. It's a digital asset primer. In brief, only the first inning. They've got enough authors on here to fill out an entire baseball team. But by the numbers, it's estimated that 21.2 million US adults own digital assets. About 14% of US adults own digital assets. They believe that another 13% plan to buy in 2021. That would bring us to a total of 27% of the United States population will use or own cryptocurrencies before the end of the year. Now, on top of that, they say that there are over 200 million crypto users globally. There are now 11,500 plus altcoins or tokens outside of Bitcoin, although many do not have a clear use case. They are incredibly bullish in this report. They say we are only in the first innings of a major change in applications across most industries that will take place over the next 30 years. So kind of a multi-decade outlook here from Bank of America. The estimates indicate that 221 million users globally as of June 2021 had traded a cryptocurrency or used a blockchain-based application, which is up from 66 million at the end of May 2020. And then also the second point is that due to technological advances in decentralized software that is native to the internet, a new medium with distributed ledgers and blockchains at its core, it is emerging rapidly. And so when we think about this, 14% as of June of US population own cryptocurrency. But they believe that that will jump all the way up to 27% of US adults will own cryptocurrencies before the end of the year. That is a big number, but not very surprising when you start to look at the numbers like a Coinbase, which has over 55 million registered users. The bigger number to me and the more surprising number is that they estimate now over 220 million people globally own crypto assets or have used blockchain-based applications. That seems like a really, really big number. And so when you see a large organization like a Bank of America going out and putting in a ton of work, creating a report like this and releasing it and being ultra bullish, you have to think that over the next couple of decades, we are likely to see a drastic increase in the adoption of these assets, more participation from the legacy system, and also if you see an increase in adoption and an increase in institutional participation, it will likely lead to prices of various assets and various technologies continuing to appreciate for years to come. What was the most surprising part of this report to you, John?
The fact that they said 14% use it now, I wasn't surprised by that number. I was surprised that they said this report was released earlier this week, that 13% more people will hold digital assets, U.S. adults will hold digital assets by the end of the year, basically, right? The report said in 2021. So it was a little bit surprising to me that within a 3-month span or whenever they start working on this report, that we are actually going to double the amount of people of U.S. adults that hold digital assets. That was the most surprising. And obviously, Bank of America is very bullish on Bitcoin and very bullish on cryptocurrency.
Joe, what do you think?
Yeah, I think what's surprising me is kind of what's been happening over the last week or so, right? When you look at Bitcoin has traditionally moved alongside other risk assets, right? When you look at kind of the 4, 5, 6, 7 year history here, there's obviously been some boom cycles, some bull markets, some bear markets, et cetera, and it hasn't been kind of a perfect outlay. But especially over the last couple of years, it's been moving alongside traditional risk assets. And over the last 1 to 2 weeks, it's really decoupled from that, right? So if you look at everything that's happening in the equity markets and kind of the other markets in finance, Bitcoin is moving outside of that. So we have a bunch of jobs aren't growing as fast, the unemployment rate is high, inflation is bad, all these things that there's regulatory uncertainty, COVID is stalling, and people aren't going back to work, all this stuff, right, has put equity markets in kind of a standstill over the last few weeks. Bitcoin's up 25% this month. We're 8 days in, right? So when you look at it, kind of its outperformance, it's done really well over the last month. And then I think if you look at it from kind of the adoption that we're seeing, it's obvious that 2017, 2020, and going forward, it's not just kind of fear or FOMO or people trying to get rich or people trying to realize profits, all this stuff and chasing all of that. there's real adoption that's happening both in the institutional world and the retail world. Countries have it as legal tender. There's a bunch of other stuff going on, but I think the main thing to realize is that like this isn't going anywhere, right? Like the saying I believe is just Bitcoin is inevitable. And when you look at it from kind of the adoption numbers that legacy banks are now putting out and all these other institutions are saying, hey, look, this is going to grow by a lot over the next short time period, but also over the long run. A bunch of people are going to adopt these assets. A bunch of people are going to hold them personally. I think what we're going to see is that massive price appreciation continue. And I wouldn't be surprised if we get further and further away and decouple ourselves further from traditional risk assets like equities.
John, what do you think about that?
At what point in time do you think that we get more uncorrelated with the other cryptocurrencies, like Bitcoin in general, and then equities as well?
I think the decoupling is only going to continue for quite a while here, but it all feeds together, right? If you zoom out for a second, here is like here's like the macro view of what's happening in the world right now. You have technology as a deflationary force. Part of the reason why there's 11 million open jobs, there's high unemployment, et cetera, is because technology is driving the cost of labor down drastically. It's actually allowing businesses to do more with less human labor. Right, so you have this massive technology force that drives down deflation. On top of that, you have politicians who now are essentially the drivers of fiscal and monetary policy. When they tell people to jump, they jump. And so what they're incentivized to do is mitigate short-term pain. If all of a sudden we are going through a transition from lots of human labor needed to do tasks to now replacing that with technology, you then have humans that are displaced from their jobs. That short-term pain politicians will not allow to occur because it's bad for business. It doesn't get you reelected if your people are suffering. So what they do then is they use both their direct powers and indirect influence to get the Treasury, the Federal Reserve, and other organizations to go ahead and participate in the devaluation of the currency. The entire idea is we can basically borrow a bunch of debt, which is a complete Ponzi scheme in terms of borrowing more debt to pay off earlier debt. Then on top of that, what we can do is we can continue to devalue that currency. We will hand out direct stimulus. We'll manipulate interest rates. We'll do everything we can to keep kicking the can down the road. But what ultimately occurs is that while it feels good in the short term to give somebody money, a $1,200 stimulus check, it actually hurts them over the next 18, 36 or 5 months or 5 years. Because what they really start to see is then they get high inflation. So right now, if you look over the last 18 months, what happened was there was a public health crisis. It drove economic slowdown. That economic slowdown led to short-term pain. Short-term pain was addressed by politicians and central bankers. They stepped in, they intervened in the market, manipulated interest rates down to zero. They printed trillions of dollars. They handed some of that money directly to people. They also handed it directly to corporations, and they also stuffed it in every corner of the complex financial system. When they did that, it felt good. I'm getting a $1,200 check. I'm getting a boost to unemployment, etc. But now all of a sudden, the bottom 45% of Americans that hold no assets and didn't participate in the insane asset appreciation that occurred by owning a house, by having some sort of stock portfolio, crypto portfolio, etc. Those individuals also happen to be the people who buy the most amount of inflationary goods. Their groceries is a very large percentage, let's say, of their actual monthly spending. And so they're the ones who get hurt the worst by the inflation that is now here. So if you're in the bottom 45% of Americans, we're talking about 150 plus million Americans, what ends up happening is that you literally got the public health crisis, then you got the economic slowdown, then you got handed money, but that money ended up actually being a net negative over the long term because now you're dealing with insane levels of rent, of grocery prices, other assets going up, etc. And so now as you start to try to operate your life, what you're realizing is, wait a second, the politicians who are mitigating the short-term pain did it at the expense of the medium to long term. And so we get in a situation where, what can I do with my wealth? Well, I can't hold dollars. I can't buy treasuries. I can go buy stocks. Maybe there's some commodities I can buy, or I can buy cryptocurrencies. But if I know that the stock market is susceptible to the same exact manipulation, the second that they say, you know what, we're going to taper, the stock market's going to crater. So, okay, I don't want to maybe participate in the same thing. I'm going to seek out uncorrelated assets. Where's the uncorrelated assets? Well, treasuries, stocks, etc. They all move together. The most uncorrelated asset, or the most attractive uncorrelated asset from a risk return standpoint, is Bitcoin. It's got a 0.15% correlation level. This Sharpe ratio is off the chart. It's returned over 400% over the last 12 months. And if you can actually stomach the volatility in the short term and hold for a long period of time, it's been the single greatest performing asset over the last decade. So you start to say to yourself, okay, well, maybe I'm not crazy and I don't want to go put a bunch of my net worth into this or my liquid portfolio, but I probably should own a little bit of it. And that's where you're seeing, Jamie Dimon say that, JP Morgan say that Bitcoin has replaced gold as an inflation hedge. You're seeing Bank of America come out and say, hey, this entire industry is going to explode. It's not just about the short-term issues. It's also the long-term tailwinds really starting to create a massive change in the economy. And psychologically now people have wrapped their heads around like, oh, they're going to continue to manipulate the economy. So let's go ahead and make sure we're positioned to benefit from it.